My name is Farhan. In this video, you are going to solve question number 12 from 2020 Paper 2 exam. Syca PLC had the following balances at 31 December 2017. So in this table, we are given two types of equity, which are the ordinary shares and the reserves. And then we are given two types of non-current liabilities, which are the 9% debentures and the 8% debentures. We have been asked to calculate the capital gearing ratio by stating the formula used. Now, the capital gearing ratio simply stands for the non-current liabilities divided by the issued share capital plus reserves plus the non-current liabilities. So it's very simple and straightforward. So the total of the non-current liabilities are 200,000 for the 9% debentures plus an additional 75,000 for the 8% debentures, and then we are dividing with the ordinary share capital of 740,000 plus reserves of 85,000, and then again adding the two types of non-current liabilities for debentures that we have. And you must convert this final answer into a percentage by multiplying with 100, and the final answer on that basis is 25%. Let's move to the second part of the question. During the year ending 31 December 2019, Syca PLC refinanced the company's non-current liabilities. All debentures previously issued were repaid in full from the proceeds of a new debenture issue as follows. So what we can understand is that on 1 March 2019, the company issued new debentures. In other words, it means the company took new loans and the interest on that loan was 6%, and the loan is to be repaid in 2040, and the amount of the loan or the amount that the company has borrowed is £300,000. We also know that the other two debentures, which are the 9% debentures and the 8% debentures, have been repaid in 2019 on two different dates, which are 31 March 2019 and 30 April 2019. Interest is paid on a monthly basis. The interest coverage for the year ending 31 December 2019 was 4.75 times. Calculate the profit from operations, which is also known as the profit before interest and tax for the company for the year ending 31 December 2019. So on the right-hand side, I've done some walkings. So let me walk you through each of the steps that I've done. Starting with the first thing for interest coverage of 4.75 times, which is given to us in the question. Now, interest coverage stands for profit from operations divided by interest payable. This is the formula you'll find on page 33 of the syllabus. So what we're going to do first is calculate the total interest that the company has to pay for the year ending 31 December 2019. What we can understand is that the financial year starts at 1 Jan 2019 and ends on 31 December 2019. So let's look into the debenture that we have. Let's look into the first debenture with a 9% interest rate that we have repaid in 2019. Now, the interest that's payable on this 9% debenture can be calculated by taking 9% and multiplying it with the principal of £200,000. But then again, if you check the dates carefully given in the question, you will see that this 9% debenture was repaid on 31 March 2019, which means in the financial year of 2019, this debenture was still in use for January, for February, and March, which are the 3 months before it was repaid. So when you calculate the interest that you have to pay on this 9% debentures, you have to ensure that you calculate it as if this debenture was used for 3 months only. So once we have done 9% multiplied by £200,000, then we are multiplying it with 3 over 12. Now 3 over 12 simply means that this debenture was used for 3 months, which are January, February, and March 2019, before it was repaid. So 3 out of 12 means it has been used for 3 months out of the whole year. And also the 9% that we normally have in the code, which is 9% debentures, it's an annualized rate. So when you do 3 by 12, this automatically adjusts the calculations for 3 months. So once you do all that, you arrive at £4,500 for the interest that we have to pay on the 9% debenture that is repaid in 2019, 31 March. Then we have the second type of debenture that we have repaid which was the 8% debenture, and that repayment was done on 30 April. So this time, this debenture was in use for 4 months, which are January, February, March, and April. So when we find the interest on this debenture that has been accrued for the year, so we do 8%, the rate that has been given to us, and then we multiply it with the principal of £75,000. And then this time we adjust it for 4 months out of the 12 months we have in a year. Again, why is it 4/12? It's because it has been used for January, February, March, and April, which are the 4 months in 2019 that this second debenture was in use for. So on that basis, you get an interest that we have to pay of £2,000 on the second debenture. Now we are going to talk about the new debenture that we have issued on 1 March 2019, which is the 6% debenture of 2000 that's maturing in 2040. In other words, you need to repay this debenture in 2040. Now, the interest that we have to pay on the 6% debenture, we take the annual rate of 6% and multiply it with the principal or the amount that we have borrowed, which is £300,000. And this time, we are multiplying it further with 10/12. The 10/12 simply means that this new debenture has been already in use for 10 months in the financial year ending 31 December 2019. How do we know it's 10 months? If you check the table, it clearly says that on 1 March 2019, new debentures with a 6% interest rate and maturing in 2040 worth £300,000 was issued. So from March 2019 until 31 December 2019, how many months do we have? 10 months. So we have March, April, May, June, July, August, September, October, November, and December. So it's 10 months. So that is why we are multiplying with 10/12. And then you get the interest that you have to pay on this new loan of £15,000, which means the total interest payable is £15,000 that's coming from the new loan, £2,000 that's coming from the debenture, one of the debentures that we have repaid, and then an additional £4,500, which is coming from the 9% debenture that we have repaid. So on that basis, the total interest that we have to pay is £21,500. Now everything becomes very easy and straightforward. So using the formula for interest coverage, which is profit from operations divided by interest payable, we can use algebra and derive the amount for profit from operations. So if you check the left-hand side of the screen, you will see that I have replaced the interest payable by 21,500. So this is the main equation for interest coverage. Profit from operations divided by interest payable, which is replaced with 21,500, must equal to 4.75, which is the interest coverage or the formula for interest coverage. Then you just use algebra and you will see that profit from operations can be calculated by multiplying 21,500 with 4.75, and you should arrive at £102,125.